Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, September 24th, 2024. It's 1:20 p.m. Eastern Time. I'm starting the video, and here's what we're going to do in this one. The bulk of this video I'm going to dedicate to giving detailed analysis and trade ideas in the biotechnology sector. Now, to do that, I'm going to use my tangential flow. Biotechs are a subsector of the healthcare. The healthcare sector is the third largest sector of the S&P 500. So what I'm going to do is just a very brief update on the equity markets. Really no change in the last few days. Just to recap, this is a daily chart here. We'll just stick to the daily time frames. You had the primary downtrend line off the highs. You still have what I believe pretty solid evidence of a major top in the NASDAQ 100, the index I'm primarily focused on and usually trade. That's the primary downtrend line. Fed day, we popped up the day after the Fed, not Fed day. Fed day actually closed down red. And then the next day, this schizophrenic market that it is decided they liked what the Fed was selling and popped up. But we've had virtually no follow through. We've traded sideways now for 4 consecutive days. And remember, we also gapped up into very significant resistance. This 486.79 level was the all-time high there. We had a breakout, which proved to be a failed breakout with a big divergent high, followed by a bearish engulfing candle, and then a failure back below that level, making this a bull trap, aka failed breakout, and rejected there. So far, not rejected. I would call this stopped or testing that level. I do expect a rejection. That's what I favor. And then all in kind of moment once the breakout fails. I'm talking about the post-Fed breakout and we break back down below the trend line. Obviously, if it goes the other way, there's a big old gap there, and that's going to increase the odds we go to new highs. If this gap here, top of the gap at around 496.50 or so is taken out. So, and that hasn't been yet. It's S&P 500. It's a much more diversified index, as we know, and I'll get to the sectors here in a second. That's how my flow is going, starting with the bigger picture of the equity markets. S&P 500 made a new high, but it also put in this island top recently, had gaps separate on both sides, a little doji stick. Same thing. There's just a lot of post-Fed volatility. We're going sideways. That was the Fed pop too, and we're going sideways there. It was a ever so slightly incremental marginal new high above that previous high right there, and still very much it only extended the divergences that had gone into that period. So typically, the bigger the divergences, the bigger the ensuing trend reversal once it takes place. So that's my outlook there. Now, we're doing this video for, again, both trade ideas and micro analysis or detailed analysis of one sector or subsector of the S&P 500. And I say that because an index, I often say, is simply a sum of its parts. And so we're going to go through that real quick. So here's the S&P. This is probably, widely considered probably the most important index out there. Most folks, 401ks, you have an S&P 500 index fund. You don't have a NASDAQ 100 index fund. This is the most widely traded and held fund right here. So you also have in there 11 sectors total, with the largest by far, not even a close second, being the technology sector. So called a major top on that there with that divergent high and bearish engulfing candle, followed by the beautiful bearish rising 60-minute or daily. No, it's a bearish rising wedge pattern breakdown right there, and that gave us that first leg down. We milked the whole thing and then some, because we milked 2 counter trend bounces. Really on the NASDAQ. This is a mirror chart of the NASDAQ 100 because of the heavy weighting. Remember, it's a 1/3 of the S&P. It's about half of the NASDAQ 100, so a much more concentrated weighting in there. And so we milked it down, gained a couple counter trend bounces along the way, covered all shorts and went full to a full long position on the August 5th lows, which wasn't just mere, pulling it out of there kind of thing. It was a lot of price targets, including the NASDAQ 100 futures hit and the 200-day moving averages on the S&P 500 and all the other reasons cited, and this primary uptrend line. So major uptrend line. It's not going to break today, tomorrow. I can't go beyond that. Maybe next week, maybe 6 months from now. have a price alert set on that, because when tech breaks, the market breaks. And so far, tech has topped the $1 million question, and that's, subject to one's opinion. Is it a top, or was it just a correction and an ongoing bull trend? Again, the odds are going to go up. Watch the 200-day moving averages, which we tested a couple times. That's where buyers step in and buy. That's what expected them to come down to on this correction, and buy it. And they bought it. So when these levels go with conviction, tech is volatile. Sometimes you'll punch through them for a few days. And again, you have the primary trend line just below. So once that goes, the 200s are going to be clearly in the rearview mirror. And the fact that we tested it and came back and tested them so quick again, typically it's a sign of weakness. Usually in a strong bull market, it's one and done. You come and test them, and if you weren't ready to buy the 200s, they didn't let you back in until this time around. So we already tested them, and we tested them again. If we go back down through them and test them one more time, we'll probably, in my opinion, very likely break them. But as I like to say, and I repeatedly do, support is support until unless broken, and we're above those right now. So you can't get crazy on the short side at this point in time, in my opinion. But I just want to show you the posture there, and again the weighting. Now we're gonna drill it down a little down into the next two sectors, and then I'll go into the healthcare and biotechs. Financials. Again, this is why you've had outperformance in recent months since the NASDAQ 100 peaked, with tech taking it down and still keeping it well below those previous highs, because you had the other cylinders in the S&P 500 firing, and primarily the two biggest, the second and third, healthcare and financials. Financials is the second largest at a 12.4% weighting. Again, so that's nearly almost a third of what the weighting is on the tech sector. So we've certainly keep an eye on tech. And, we recently we've had these series of divergent highs, and it's not as if each didn't pan out. They also, all of them played out for a double digit or near double digit drop. And in doing so, they're just one large, the divergence that started back all the way back here has continued to build. And again, it shows better when you see the long multi-month divergence go out to a weekly chart, and you can see that divergence very clear, as I just did here. So divergence is not a sell signal, but what is a sell signal? It breaks of trend lines, as I highlighted here. We had the break in the financials. It was put on as a short trade idea there. I gave you these targets on the daily chart right there, here, the trend line. Here, these are the initial targets. We hit the first on the daily, but I also gave it to you on the 60-minute chart. Gave you 4 targets there for near-term swing traders. We hit T2, we bounced, came into the Fed, and as I said, around Fed week, you may want to suspend, hold off on stops, because of the what I call post-FOMC noise that is certainly on the day of and the week of the FOMC meeting, and it's the following week where that noise tends to abate. Does take up to several trading sessions into the following week for the market to kind of really realize what direction it's going to go, and then any whipsaws by then will be out of the way. So I'm still viewing that as most likely a whipsaw. We're still above the previous highs, and more importantly, we broke down. I give you this little minor trend line, BOD trend line, little bearish rising wedge, and another divergent high on the 60-minute chart. You can see wash, rinse, repeat. Get these divergent highs, as I showed you a minute ago, even on the daily. They're usually good for double-digit drops. We already hit T2 to the button and bounce right there. Therefore, as we come on down here, we need to break that minor support there about 45. We just did today, so that's taken out, and T1 was already hit. So while we could certainly, if we go down to it again, which I expect, we could certainly bounce, but I don't expect to bounce. The reason I have multiple targets, as I state in the FAQ page, upon the initial tag, that's where reaction's likely, and sometimes that's it, and that's where it ends, or you hit it again and bounce. But it increases the odds the next time around. You may get another minor reaction, but you're going to go on down through there and hit the next target, and then you have a reaction. And so therefore, T1's been checked. T2's been checked. And so if we start to head down, that's going to firm up the bearish case on the daily chart and increase the odds. We'll start snowballing, more rapidly selling down to T3 and then ultimately T4. All right, so there's your update on the top two. Healthcare, third largest, close to the financials, but a little lower weighting. I updated these a couple weeks ago, 11.73. So again, collectively, you've got about almost a 25% weighting, about a quarter of the S&P 500 weighted with financials and healthcare, and again, about a 1/3 weighting in the tech sector. So this is the one we're going to focus on. As I covered in recent videos, we broke down. We had a nice clean up trend line there. Big old divergent high, i.e. bearish or negative divergence. That divergence has been building for a while here. Broke down, and we didn't just break down. It was a solid impulsive breakdown. And so what I'm going to do for you right now is out of line, because we've had Fed meeting and all that hype around that, get a little pop, but they're selling. This sector seems, at least near term, it's under distribution, especially post-Fed. And so about 153.60, about where we are right now, we break that to take out that previous reaction low. We'll probably head on down to some of these additional deeper targets that I have. And again, the takeaway is twofold. You can trade these as a direct trade via XLV. That's the ETF that tracks the sector. That's what we're looking at. Or individual stocks. That's my preference in healthcare, because healthcare is such a broad industry. You have all different types of companies in there: biotechs, pharmaceuticals, medical device makers, and all that. And they all have different business models. Even within pharma or biotech, you've got drugs in the pipeline. Some companies, Merck pipeline's drying up and has been drying up. You've got other companies flush with pipelines with new drugs coming out. So there's just so much variance there. And again, that's a sector typically I like to cherry pick and go long the most bullish and short the most bearish. Other sectors like gold mining stocks, GDX, to be bullish gold and silver is to be bullish the miners, and vice versa when you're short, and they all tend to move together. So now we're going to drill down to biotechs. Again, a subsector here. There are 3 biotech ETFs out there that at least that I've tracked for years. The 3 big ones: PBE. I'm just going to go over the charts, and then we'll end up on XBI, and I'll drill down to the components. Not all of them, but most of them, to give you an idea of how the individual stocks look. So this is a daily chart. I can scroll back here. I'll just go back to, we're back here to 2020. There's COVID lows right here, just to kind of put things in perspective time-wise for you. And, it's a big part of my trading. These aren't the be-all end-alls, but if you can wait patiently and look for, during a trend, in a bear trend, you want to see as the trend starts to weaken. These are your momentum indicators down here. PPO, you can use the MACD if you don't have a PPO. It's a close cousin. RSI, there's others out there. I've got a lot of indicators on my charts and different charts. But these are the go-to ones. And it's very simple stuff, because they're momentum indicators. When the momentum in a trend starts to wane, you're going lower, a bear trend, everyone wants to sell, get bearish. But then when you see the indicators making higher highs and prices are making lower lows, indicators making higher lows and prices are making lower lows, that's what we call positive, aka bullish divergence. And that's indicative that a trend change is likely. And so wash, rinse, repeat, and vice versa on a divergent high. Prices making higher highs with the indicators making lower highs. And then again, divergence is not a sell signal, just like overbought or oversold are not buy or sell signals either. They're conditions. And so when you have certain conditions, such as positive divergences, oversold, overbought, then you look for buy or sell signals. And those come in the form typically of a breakout of a bearish or a bullish chart pattern, or a trend line break, or price support. So divergent high, sell signal, breakdown, double digit drop, divergent high, trend line break. And before it was all said and done, you got that bear market right there. Divergent low, bullish at long-term support. I don't have this chart. I don't always track or trade this one. I'm sure on the 60-minute you had some buy signals or something. Or you can also buy to support, by the way. I always say that there are 2 objective ways to go long a stock. You either buy a breakout above resistance. That resistance may be the top of a bullish chart pattern. Or you buy a drop to support if you think that support level is going to hold. Simple stuff. And when shorting, same thing in reverse. You buy breakdowns of support, like right now I'm looking for this uptrend line. That's what I'm going to focus on. Or you buy short rallies into resistance. Now we don't have any solid resistance right here. There's a little I could add at that level, certainly, but let me move forward here. Just continue on showing you the divergent high, drop, divergent low, rally, divergent high, drop. And we have the most recent divergent high, which puts me on the lookout for a sell signal. Now, the sell signal in this case right now, the highest probability sell signal is going to come on a break of this uptrend line. Should we make another thrust up anytime soon, it will not in any way, shape, or form change the technical posture or the outlook for PPE. You're just going to simply extend, and I'm going to move the line right here, just like in football. When you get a first down, they move the markers, and you get another 10 yards. So until I have to move this, and then there's no longer divergence because we've taken out the previous highs. In fact, also, I just noted on this one, the divergence is much larger. So we do have this near-term divergence right here, but the divergence has been building since back right here at that previous divergent high. So this is really technically what I call DH1, DH2, a much larger divergent high, but you have that smaller divergence. And again, when I listen to my words carefully, anytime soon we have to make that. And because if we go around for a year or so here, or 8 months, and move up, who knows how the charts are going to look. I can only tell you if we have a thrust up anytime soon and make that marginal new high, based on how far the indicators are lagging behind, you will be guaranteed to have a divergent high. But we already put one in there, so as of now, I treat that as a potential top. And as you can see, we have a trend line there. I should have labeled that. This isn't the go-to one. I'm going to show you the one I have marked up targets for you. That should really read S1. This is the first support. I'm sorry. This trend line is certainly the first and probably and definitely the most important support level. This is also a very, very big price resistance. Why is that? Why did I say very big? It's just a huge level. It goes back here, major reaction low. If my circle tool will work here, let's click on it again. 1, 2, 3, little shot down there, but you back up and then lost it, and the bottom fell out of the sector. You rallied back, tried to get through it, hard rejection. Rallied again, rejected. Rallied again, rejected. Hard rejection. Another bear market down to the lows. I'm talking, well over 20% drops. Got there again, rejected, rejected. Another big drop. And this is a breakout that is bullish unless it fails. When does it fail? Back under 67.73. So again, that should be, for all intents and purposes, S2. First support being the trend line. Then just below it is the 67.70-ish support, which is also what I often refer to as a BOD, or benefit of the doubt support level. What does that mean? If you're new to the site, it's a term I made up. You can short the trend line, it'll probably pan out. But if you want to give it the benefit of the doubt, because this isn't a bull trend and you just broke out to new multi-year highs in the sector, give it the benefit of the doubt and wait for a break of 67.70-ish. It's not much farther below. If you look at the profit potential, I don't know why I didn't list it. I did on the other ones. T6 is all the way down here. I'm looking just like the stock market for a move back down that's going to go to at least on the next trend down, the next leg down, to test the late 2022 or the 2022 and or 2023 lows. And so put it in perspective, I'm looking for a drop of at least 25%. I keep saying at least because if and when we get there, depending on how the charts look, I'll be analyzing it, particularly on the weekly charts too, and may add additional targets. So there's your potential targets. So let me move on and just show you the others. And I'm doing this just to kind of give you a broad-based view of the sector, or a comprehensive view of the sector, I should say, because each of these ETF companies hold a different basket of health or biotech stocks, and many have a overlap. So there's really, in my opinion, no point of shorting all of them. But they have higher concentrations in some holdings, and some hold some that others don't, that kind of thing. All right, so you can see here, again, this is IBB, number 2, simple stuff. There's your uptrend line, divergent high, big breakdown drop. That was really DH1 with a larger, simply extending the divergence. You can see I had it drawn up there. Bigger divergent high. From there, the biotechs fell after that divergent high was in about 41%. So I think that would qualify by most people's metrics as a bear market, and there was the trend line break. How did that bear market end? Well, no coincidence, with a big positive divergent low, bullish divergence, and started a new uptrend. That uptrend kind of went sideways for quite a while. Well, I mean, we had an uptrend till we put in a divergent high that ended it right at resistance, sent it back down to this, and then this range developed here. We had another divergent high there, rejected. So boom, boom. I'm trying to draw my arrow tool now. Boom, boom, couple rejections off that level. This is a breakout, as I like to say, and I've said it repeatedly lately. A breakout is bullish unless it fails. When does this one fail? About 139.50 right there. As I like to say, there are fewer things in trading that are more bearish than a failed breakout. So you have a bearish rising wedge, very clean up trend line in which to trigger your first sell signal, with a second or all-in kind of moment on a solid failure back below 139.50. There's your next support / target, and that should take us back down. If the breakout fails, odds are we're going back to at least the bottom of the trading range there. And to quantify it for you in IBB, that's going to be about a 22% drop. All right, moving on to the next and last ETF. This is pretty much, the go-to one I usually post as trade ideas, or the leveraged versions. They have LABU and LABD. I'll get to those in a second if you want to just go with a ETF instead. Just to kind of recap this one, rolling back as far as I can, 2019. This was a divergent low rally, divergent high correction. Actually, it's not labeled there, but it's drawn. That's a divergent low. There's your divergence line right there. That capped that pullback, and that was a rally. So really, wash, rinse, repeat stuff. It's not as simple as just recognizing the divergent highs and lows. It certainly helps, but it's also finding the buy and sell signals. Sometimes they're not just a trend line or a price level breakout. Sometimes they're bullish or bearish candlestick reversal patterns. There's all types of ways to help identify a trend change or a buy or sell signal. Bearish rising wedge, divergent high drop, that was double digits. Doesn't look like much because we're looking at all the price history on a very volatile sector. This is the bottom of the range is $62 on this ETF, and the upper end's about 180. So you're looking at a big price swings here. Let's zoom in a little bit closer. Big, massive divergent high. There was your sell signal, and that was a bear market in XBI of about 65%. So there's a lot of meat on the bone when you trade this sector if you can get it right. I haven't covered it a lot lately. I have, I always update this and all the sectors at least several times a year in the S&P 500, but I've stayed away from it because of this. It's been in this sloppy range. We had two downside false breakouts that both, when they were, both of them put in divergent lows after we had those false breakouts. They were bear traps. Those are very bullish, and sent it back up to the top of the range both times. And you can see we had a false breakout here recently on the top of the range, also coincided with a divergent high. I even spoke to it back then, acknowledged the breakout, and told you my prediction is the breakout would fail. It did, and now we have another. You can look at it as another breakout, but when we had this breakdown, then that established a new reaction low. They bought a little below it right there, a little above it. There's a great example too, guys. When all eyes, like the Intel trade we have right now, we have it's this like in reverse. We have two reaction lows. I've been talking about that, and why my preference is going to be to cover these two major divergent lows, both equal. All eyes are going to be on them. You can blast right on through there, but odds are you're going to see sellers step in early because it's so obvious. And so in XBI, you can see there was an example of that. The bottom was right here, so everybody was looking this. Long, shorts were getting, if they did, were getting greedy and wanted to cover right there at 62.10, but boom, they stepped in and reversed it early. You had some positive divergence down there on the RSI, and you had an explosive rally. And the market also bottomed then. It's like everything else. If you're going to trade XBI, these are things I've learned over the years. I try to pass along these, things I've learned. If you're trading the biotechs because that's your thing, and some people only trade one sector, you're doing yourself a massive disservice if you're trading it in a vacuum, if you're only looking at the chart of XBI or just XBI and those two other biotech sector ETFs. I like to look at all three of the biotech sector ETFs, and I like to look at as many of the components as I can, at least the top 20 or so. In addition, you want to look at the stock market because it wasn't mere coincidence. The stock market bottomed right here in late October of 2023. Right there, we had a major low. Also, low back then. Let me see. Hold on. This is the SPY. Let me look at that. There was the major low in 2022, and then in early it was November. Right here, we had a major low. Late October, yeah, right there, and with positive divergence. So again, if you're trading this in a vacuum, you would have missed that. Hey, there was a major bottom. Remember, we were going in the beginning of the year here. We were going long all the tech. That's when the Nasdaq bottomed in early January, but the S&P bottomed here. I'm sorry, January 2023. We're going back a year. No, this year, right, 2024 as well. So that's the takeaway there, is that sometimes you reverse a little shy of those levels. Hence, if you were shorting down and that was your target, you might want to cover a little below. Now you do see I have T4 right here this time. That's because I think this time around, if we get anywhere near there, you're going to have such panic in the market. If we start heading down to those previous lows, you're going to be waterfalling, selling down. You're not going to be walking down. The market's going to be running down, in my opinion, and you're probably going to overshoot those levels. So I probably would even extend that out. But I am. This is 10. This is actually literally 1, 2, 3, 4, 5, 6 steps ahead. I'll talk about T4 if and when we start getting there. It could be revised, could be canceled. I might, quite often I'll pull a trade, one target's hit, and that's it. I think we're going to bounce now and reverse. So I just wanted to kind of lay them out to give you a bigger picture plan. And then the rest of this video won't be very long. I'm going to go through maybe the top dozen or so holdings in this sector. And also to do that, to show you, as I said earlier, an index or sector is simply a sum of its parts. So the S&P 500 it's really a weighted sum of the 11 sectors, but it's also a market cap weighted sum of the 500 companies that it tracks. In the biotech sector, when I look at this, because they also have different business models, they tend to move a little more in sync overall, the biotechs, than the overall healthcare sector. Again, that's a more diversified sector that's inclusive of biotech stocks. So you have more correlation in the components of XBI than you do in XLV, the healthcare sector ETF. So with this, and I'll even go a step further, my preference typically is to trade these biotech sector ETFs for two reasons. Number one, we are getting close. We're starting to get near our next earnings season, and soon it'll be in earnest in a few weeks, I guess. I'll have to check when the biotechs, when they tend to report. So there's that, and then you don't want to be, holding. You just have a lot of risk holding individual stocks, especially high flyers. Procter and Gamble, you're not going to see a 15% move after earnings usually, but on Biogen, IDEC, you can, on these biotech stocks. The other thing to that is, and it's specific to this sector, these are biotech companies, and they have various drugs. Some, as I said, have pretty broad pipelines. Some have very narrow pipelines. You get down to the smaller biotechs, and they've got the whole company's riding on one drug that's in phase 1 or 2 clinical trials. If it has come, and the way these things work is, unlike earnings, you can manage any stock around earnings because those are announced well in advance. Companies report quarterly. They publish the exact earnings date and time ahead of time, so you can close or hedge up that position and mitigate risk going into earnings. In biotechs, it's impossible to mitigate the risk because announcements of a clinical trial starts going awry. People are croaking. They're on the experimental drug, and there's some adverse events, people dying or getting really sick, and all of a sudden they announce they're halting the trial because of that. Boom, the bottom falls out of the stock. Guess how much notice you had before that headline hit? 0. There was no way to know it's coming. Same thing when the FDA decides to approve or deny, a clinical trial, a drug. Drug might be pending approval, and the company and Wall Street's expecting approval. Everything's hunky dory, or phase 2 or phase 3, wherever you are, and boom, all of a sudden there's a rug pull. Well, no, need more data, or FDA didn't like what they see. So my point is, a sector that with individual stocks. And this goes back to something else I've always said, another thing I've made up in trading. It's called the know your security rule. It goes back to the days when I was a stockbroker. We had the know your client rule, where if you came in, I couldn't just tell you to buy NVIDIA or Apple or a bond fund. I had to, sit there for 30 minutes and go through your financial history, all your holdings, your risk tolerance, your objectives, your time frame, and all that stuff to make appropriate recommendations. So brokers, a financial advisor has to know their clients' objectives and risk tolerance and all that good stuff. Likewise, if you're a trader, I have the know your security rule. Every stock is different. And so if you're going to trade biotechs, you need to know what's in their pipeline. You need to know how diverse it is. You need to study the chart, look at their history of volatility around earnings and other things like that. And therefore, you can decide whether that stock fits your risk tolerance and objectives, or it doesn't. Or if it's a very volatile one, but you still like it, you need to know that you're going to take your position size down a lot smaller than you would in, say, a big, biotech company with a very broad and diversified pipeline. Okay, so that's the know your security rule. Or again, you can go with the ETFs and you can take a look at the chart and kind of see that, how volatile it is, and then decide how to, how much to put in there if you decide to take these. Okay, moving on. XBI. Again, this is kind of the main one I look at. It's the S&P, the Spiders S&P Biotech ETF, so very well diversified. Got a lot of biotechs in there. Most are all the big names that you would know. Nice clean uptrend line, coupled with, this is my divergence line. I don't know, sometimes these lines just didn't have it in there yet. I've just marked this chart up today. I'll give you some targets here. That's it. There's your negative divergence, which actually goes all the way back to here. Let me add that in with a permanent line. So just like the others, you have a divergence steepening right here. All right. And you have divergence that's really been building since that previous high. We have about equal highs in prices right now, almost exactly, and lower highs, which is negative divergence. So the last time we had divergence was a much smaller divergence, yet the sector still fell about 22%. That's about a 22% drop. Again, there's no set rule or formula, but typically, generally, the bigger the divergence, the bigger the ensuing trend change. So my expectation is not another 22% drop. That would take us right back to where we stopped there at T2, which is still a level I think there'll be a reaction, 81. And so I'm expecting a bigger drop there. And so that would give us, from the recent highs, if it plays out, going to be about a 40% drop in the sector. Is this an objective, actionable trade now? No, I'm doing this trade in this video. These are trade setups. You can screenshot the charts. I did give you targets on my preferred one right here. And levels too. Like I said, S1 is the trend line right there, right? And price support comes in just below, about 94.78. Even S2, in my opinion, is a little too. You can make that a target, but it's not much of a drop. I wouldn't, and nor would I plan to cover there, because if we fall back there, we've fallen back into the trading range. We're probably going to go a lot lower. And again, you guys, pick your trades, pass on the ones you don't like. That'd be about a 6% drop to get us down to S2 from where we're at now. But I put T1 down here, and that's going to be about almost an 11% drop. T2 is about almost 17. T3 is about 25, and T4 is going to be about 36% from where we're at right now, that is. Okay, dokie, let's go into just a few of the top. As always, when I do these videos, or usually I should say, let me mark that divergent high right there on that one. I look at the components here. I have a watch list attached to all my charts. When I queue in an ETF, it's going to load up all the components of that ETF, and I have them sorted by market cap. So you can see AbbVie is $341.6 billion. It's the largest. That doesn't necessarily mean it's a top component of this sector ETF. Some of these, the NASDAQ 100 and the S&P are market cap weighted. So when I do this, they are the largest components at that point in time in the sectors. You can go to the website and pull it, but either way, you're going to have a pretty heavy concentration of this one in there. And the point is, as I go down the line, I'm not going to go through every component. The video will put you to sleep. There's 135 stocks in this ETF. At least that's what it's showing me on my watch list to the right. So I'll only go through the top dozen or so. And again, that gives you an idea of the sector, also how similar most of the charts are at this point in time, right? AbbVie, so that was a long-term trend line that was broken there. We even had a divergent high there. I haven't really traded this one, so I don't have this chart fully marked up, but you kind of get the gist of it. These things go up. They're little rockets. People think they're going to go up forever, like NVIDIA when it was going up and will never stop. And then you have like what the utilities had, that blow-off top lately, and then nobody wants to short except me, usually in those situations, and very few, but that's when you want to be shorting and you don't want to be buying those blow-off tops right there near vertical. But then the trend line break came and boom, and then you put in, again, I haven't had this one marked up, but this is what I would have been looking at the time, positive divergence there. And so most importantly, you have this primary uptrend line right now in which to trigger a sell signal. And again, the point is, if you're really serious about engaging this sector on the short side, this is what I tend to do. I'll watch it closely, and if I'm not doing that, and I'll probably do it anyways, set price alerts on the ETFs that I just showed you, what levels need to go, and then on the leading stocks here. So one day, if you're sitting in front of your desk and your alerts are going off like popcorn, this one's breaking down, XBI is breaking down, that's going to increase the odds that those breakdowns are going to stick. Likewise, or on the contrary, if you only get one breakdown, maybe AbbVie breaks down, but then you look in IBB and XBI and PBE, those big ETFs, they're still above support. You may not want to short AbbVie because the sector hasn't broken down. So that's how I'm wired. That's why I do these long-winded videos. That's why I look at, up to, in this case, 50 or more individual securities just to determine if I'm going to short one of them, like XBI, right? I'm going to look at XBI, PBE, and the stocks I'm covering now. And because when you tend to try to call tops and bottoms like me, most say you can't do that. I've heard the clowns on CNBC for years. A lot of them come out and say it's impossible. I've made a living off doing that, and I like to call tops bottoms. Sometimes I'll trade continuation patterns or add to a position that's already turned that I got. But my point is, you got to have a lot of evidence to do it. You can't just have one stock break down and think it's going to go down, because remember, again, birds of a feather flock together. So how far is this one going to drop without the entire sector going down? And it could. These again have their unique business models or pipelines, drug pipelines. But either way, those are your levels. You can see them. You can screenshot it if you want to trade any of these as individual stocks, or maybe you own them already. This one's been building up the divergent highs. This is Amgen, AMGN. I don't know if you can see it in the video. There's the Amgen's a big one. Nice, clean uptrend line right here. We had an uptrend line here. It was broken. That was your first sell signal. Like a lot of things, including financials and the healthcare sector, it had a little kickback rally. And now this is your secondary or benefit of the doubt trend line. So we put in a divergent high there. As of now, that is the high. And if we go a little higher, it's not going to change the technical posture anytime soon, because this divergence cannot or will not be taken out as long as it's only, again, a marginal, meaning slightly higher high. If it's anything much more than that, yeah, maybe the divergence is gone, and then I start looking at other things. REGN, this is what happens. This is a sector that these guys are high flyers, and when the turn comes in a lot of these, it can come pretty swift. This thing broke down. I'm highlighting the sector today. I didn't have a price alert with this, or I would have done this for you a few days ago, but it's already down 10% in 2 days. And, again, the more of these you see breaking down, the more likely the entire sector is going to roll over. So this one's coming up on first support slash targets here. And but that's a pretty convincing breakdown and top right there. Also divergent high. I don't have all these labeled, but if you see the lines, you can see and that's why I do these videos. It just almost all of them have put in big divergent highs, and as they have in the past before other big, trend changes, and a lot of them, broke down. There's a breakdown, back test. You had some price support there. Next support was there. Let's see, hit that support. That would have been my first price target if I was trading it. That's VRTX, Vertex Pharmaceuticals. Kicked back to the support once broken, becomes resistance. So it's been trading in this trading range here with this little false breakout above it. That was a breakout to new all-time highs, which failed. And so this one just needs a little bit of nudge. If it drops much lower, you can see it's dancing on the bottom of that trading range. Boom. It's going to drop down, hit the 200-day moving averages and its primary uptrend line. They'll probably buy it there unless the sector's rolling over really hard at the time. Bounce up, and then when the trend line goes in the 200 days, you're coming down to 409.50. Then it's going to drop down to about somewhere in that range. And ultimately, again, I'm looking for swing trades that could last months and high double-digit profits to the downside. Divergent high. Look at that beautiful trend line. That's Gilead, GILD. And Gilead has this, it's kind of like natural gas. This sucker's either full throttle up or full throttle down. That's why I'm sharing these trade ideas for you. So key is I do these videos ahead of time so you can mark up these charts. If you want to trade it, engage it, have the trend lines. You've got to be ready, because if you're too late to the party and you're waiting for Kramer, some clown on CNBC, to tell you it's time to short the sector, these guys are going to be down here. I want to short here early on because they tend to fall fast, and that's where most of the gains are made once the turn comes on a lot of these guys. Same thing on the upside often when they turn. Not always. Sometimes this one pounded out a bottom here, but either way, I'm just showing you the clean up trend line in which to trigger a sell signal. Just set an alert. Divergent high, keep an eye. If these alerts don't go off in the next week or 2 or 3, revisit and bump me. If you have any if I don't give you an update, it's because the sector hasn't broken down yet. If if it breaks down, I'll give you an update. Right now, it's just, again, a setup. Most of these are trade setups. Even that one I just showed you that broke down, because the sector hasn't yet. And this one's it's already down 10%. It's coming up on support. I'm talking about Regeneron. Kind of missed the objective entry on that one. ALNY, there's the bearish, look at that beautiful divergence. Bearish rising wedge, just need to break the trend line, just like you had a divergent high there, and the stock fell from that divergent high. It fell 42%. Probably had a nice little trend line there, which triggered the sell signal. Ended with a divergent low, bullish falling wedge pattern, breakout, back test, boom. From there, the divergent low after the breakout, it rallied 95%. So it's simple stuff, not super simple, but really, watch these divergent highs, wash, rinse, repeat. And again, I didn't mark them all. That's a divergent high right there at that one before that. All right, you get the picture. I can go through them all. Biogen, this is Biogen. Big divergent low, but not this. It's kind of a meh stock. This one's got problems. When the sector's near 52-week highs and you have a stock near 52 or multi-week lows, something's wrong. It's that support. But being that the sector's about to break down, not one that I care to buy. If you put a gun to my head, I'd buy it versus short it here. But if it breaks that, that's very good support there, about 190. And this thing could open the door to the next big drop. When you look at it on a weekly chart, which I'll do right here, you can see, this thing's got problem. This stock peaked way back here and been moving around this trading range. So let's not spend too much more time on it. I'm not one of my favorites. mRNA, you all remember Moderna from the pandemic. Yeah, this one peaked back here when COVID, pretty much everybody realized COVID's nothing more than a bad cold, if a mild cold now for the most part. It's down almost 90%. So the suckers that bought this on the vaccine hype, what Moderna needs is another government created a virus to create another global pandemic so they can bilk the government for billions in contracts again. But you can see they were a one-trick pony with the COVID vaccine, and they're at support, so I wouldn't short it. Again, it's just like the previous one I just covered, Biogen. It's at long-term support. If anything, all I can do is tell you it's subject to go long there with a stop somewhat below. It even has positive divergence. So, but overall, and that's why I do these long-winded videos, collectively, most of the stocks are looking bearish with big divergent highs, overbought conditions, and look like the sector's about to roll over. But what I like to do, what I did with Intel, it's my one long and a sea of semi-shorts. So, and which I'm looking to certainly add to once the breakouts fail there as well. And so while the majority of semis look longer term bearish, there are a couple breaking out today. I'm going to go over the semis. I do want to do an update in that sector. I have quite a few that just broke out. These breakouts are either going to fail or stick. So let me loop back to that in another video. I'll give you an update there. But most importantly for the semis, I think the breakouts will fail. And they have the same downtrend line as I've covered recently that the indexes do. And it just needs to fail back below that downtrend line. A lot of these breakouts have failed. But on this one, like I said, you've got a at support, bullish falling wedge. But yeah, no, I'm not buying this one or putting it on as a long. You can do what you want with your money on that one. UTHR, United Therapeutics. Look at that beautiful little uptrend line. Just set alerts on these little suckers, and boom, breaks. It's going to drop to 31.11.25, down 11%. Probably they'll step in and buy, most likely there, get a reaction, and then it'll break that, drop down here. That's about a 20% drop to 280, and so forth and so on. All right, you get the picture. To go beyond here, it's going to be a little redundant because most of these have the same technical patterns. Just like we had divergent lows, bullish patterns back here, downtrend lines, bullish falling wedges, and breakouts. You've got pretty much the inverse setup right now in the sector with big bearish rising wedges and, divergent highs just like you did back here when this one fell off that divergent high before all said and done, dropped 80%. So, all right. And also it's right at that previous highs, those previous highs back from about 2021, throughout 2021. Okay, I'm going to wrap the video up here, get it out to you, and see what else I can find. This has been Randy Finney with Right Side of the Chart. Have a great day.